If you watch Friday's rate breakdown video, this is what moves those rates over the next 2 weeks. The labor market just posted its worst 2-month stretch since 2020. I'm Robert Homewood with Open Lane Funding, and here is the economic data behind everything we've covered this cycle. July non-farm payrolls came in at negative 23,000, the first negative monthly print since 2020. June was also revised down to negative 20,000, confirming 2 consecutive negative months. Unemployment fell to 4.1%, but only the falling labor force participation, not a genuine improvement. Wage growth decelerated to 3.2% year over year. That's the slowest since May of 2021. At the same time, inflation cooled. July CPI came in at 0.1% month over month, 3.4% year over year, down from July's 3.5%. The core CPI rose 0.2% month over month and 0.25% year over year. That's the second straight month of disinflation, landing in the same window as the jobs miss. Here's the pattern interrupt. You might think 2 soft job reports plus a cooling inflation automatically means a September rate cut is locked in. And here's why most people miss the real risk. The Federal Open Market Committee held rates on July 29th at a 9-3 hawkish dissent. And those 3 dissenting members, Hammock, Kashtar, Kari, and Logan, voted for a hike already knowing that the June's labor data was soft. A genuine hawkish committee faction may discount an additional weak month. Now, especially if you read that the 3.2% wage growth is still historically firm rather than alarming. Weekly jobless claims ticked up to 209,000 for the week ending in August 8th, above the 202,000 consensus and up from the 200,000 prior to the week from the prior week. And that's a mild deterioration, but it's still historically low. For the week ending August 15th, released August 20th, claims actually fell to 206,000, below the 210,000 consensus, and down from the revised 212,000 the prior week. But the 4-week moving average rose to 204,000 from 190,750. The continuing claims climbed to roughly 1.8 million. That's the highest level in the current stretch. The headline improved, the underlying trend did not. It's taking longer for job losers to find new work, even as layoffs stay sparse. Now, this is a good moment to ask you to subscribe, because if this kind of macro to mortgage translation is useful, I'm the only channel in this space connecting jobs and inflation data directly to what it means for your DSCR file, not just repeating headlines. Here's the loan structure implication. Given the reopened two-way rate risk into the September 6th to 17th FOMC, maintained the guidance from Friday, avoiding floating on any commitment closing before that meeting, but now also flagged genuine downside rate relief potential for clients. With the flexible closing timelines, who can afford to wait for the post-FOMC clarity? Right here in the inland Northwest, this macro shift matters because Spokane's own July data posted its first negative year-over-year median price print of this cycle. Now that's down 1.3%. Whether it's a genuine local trend or just a single month volatility connects directly to whether the broader labor deterioration bleeds into the regional household formation. Now I'm going to go deeper on that specific question on this Friday's video. Here is where competitors are getting this wrong, though. The firms that pivoted hard to a rates staying higher for longer message right after the July 29th FOMC dissent are now behind the curve. The July jobs and CPI data materially reopened the case for a September rate cut, and the messaging hasn't updated. That hasn't updated is anchored to a 3-week-old reaction, not the current data. So, two upcoming catalysts that we need to watch for: the second estimate of the Q2 GDP on August 27th, and July's PCE price index, the Fed's preferred inflation gauge, on August 29th. Now, if you want actual loan scenarios and deal structures behind all these numbers, make sure you book that call at openlandfunding.com. But until then, I'm going to see everybody on Wednesday with a quick educational piece on wholesaling, and then Friday when I do a deep dive into Spokane, Coeur d'Alene areas. I appreciate you guys, and I'll see you then.